nations like China, Japan, Singapore, Switzerland that have embraced digital assets and blockchain technology, and they've created robust national plans to be global leaders in this area. And the United States is falling behind in technological innovation, and this is not a risk we should be willing to take. One of the challenges that innovators face today is a fragmented regulatory regime. Businesses that are pioneering in the digital asset ecosystem have many different regulatory regimes to navigate through. In order for the US to benefit from this generational shift in finance and technology, regulators not only have to take into account the delicate balance between regulation and innovation, but they also have to coordinate among the many different regulatory bodies that all have jurisdiction in this space. So businesses have the clarity that they need to innovate in this emerging area. And today, we are pleased to welcome some of the nation's top financial services and banking regulators, as well as industry pioneers across the blockchain ecosystem, to discuss this delicate balance of innovation in regulation and also have some coordinating conversations. Before we get started, I'd like to introduce our co-host of today, Dan Doney. He's the Chief Executive Officer and the co-founder of Securrency. Dan?
Yes, thank you, Perry Ann. It's really my pleasure to, I am Dan Doney, the CEO of Securrency, and it's really my pleasure to kick off this fantastic event that really brings together some of the leaders in the industry. I'm going to give you a quick summary of the digital asset market to kick things off and help you understand where things are today. We're excited because there's never been a better time in our industry as blockchain is now going mainstream among some of the largest financial institutions, even at the government level. We're seeing rapid progression in payments, capital formation and trading, and very exciting developments in decentralized finance. Specifically in the payment space, there has been an evolution from cryptocurrencies, which have given rise to stablecoins. Stablecoins being financial instruments that are on blockchain that are backed by or pegged to fiat currencies, oftentimes backed with those currencies in a bank account, which is in economic terms known as M1. These instruments have actually overtaken cryptocurrencies in terms of daily activity and daily volume. This has given rise to another very interesting development, which is central bank digital currencies. In economic terms, this is M0. These are financial instruments issued by the sovereigns, that is by the countries themselves and their central banks. There are over 30 countries now participating in pilots with central bank digital currencies, including the United States, as the Boston Fed and MIT and a number of others are participating in pilots with the digital dollar. Now, as Perry Ann mentioned, this is actually at the center of the development of a Cold War in finance, as a number of nation states have openly stated that it's their intent to use these tools to take down the US dollar as the medium of exchange in financial markets. So the race is on. These participants have given credible plans in terms of how they can displace the US dollar. So we see a rapid advance in innovation in central bank digital currencies. And of course, there is a national security interest there. In terms of capital formation, we saw the early days of the initial coin offering market where tokens were issued tied to utility. That's given rise to security token offerings, that is, instruments on the blockchain or distributed ledgers that have an investment thesis. And we're very excited to be a part of the next evolution in that space, which is tokenized exchange-traded funds. We're partnered with WisdomTree, a world-leading asset manager, to bring ETFs to the space. The reason this is such an important development is ETFs in tokenized form have tremendous liquidity, easy price discovery. These instruments are linked to highly liquid components that are traded on the New York Stock Exchange, NASDAQ, and other exchanges. So this will bring a new liquidity and institutional presence in the space as a parking spot for institutional value. Now, perhaps the most exciting developing market now, with over $1 billion a month of new money coming, $1 billion per month of new money coming into the space, is the decentralized finance world. So here we see innovative products in lending, Securrency participating in liquidity components, data components as well. There's a rapid growth industry in what promises to displace back office financial institution costs. And all of these innovations together are making financial markets much more accessible, global, and efficient than ever before. Now, with all this pressure and all this change and innovation comes pressure on regulatory frameworks. When you have commodities or securities that can behave as currencies in the financial rails, you start to see an intersection of regulatory frameworks, and there can be conflict when one instrument actually rides in potentially several different regulatory regimes. Last week, we had the opportunity to participate in the CFTC's innovation event. I spoke there. The CFTC chairman spoke to the need to innovate based on first principles. When you have these complex instruments that potentially cross boundaries, you really need to look at first principles in terms of investor protection, fair trade, fair markets, secure value, and of course, anti-money laundering. And so that requires an overlap and alignment of these regulatory frameworks. Now, I'm very excited today you're going to hear from some of the world's leading regulators on this very topic, as Comptroller Brooks has been working hard to align in the banking industry the fragmented and conflicting regulatory regimes. Perry Ann spoke to this in her opening remarks. It's these regimes that create a high barrier to entry for innovation and block real developments in the marketplace. When I can, in other countries, engage in financial transactions that are much more efficient, lower cost, easier, and in fact, even more secure than I can here in the United States, you know we have a problem, and we need to introduce more innovation into the banking sector. Now, this is meant with Chairman Clayton, who is also here. In some cases, people see the SEC on the opposite side. In fact, that's not true, opposite side of innovation. It's not true. The SEC has been pushing forward aggressively to make markets more open to all participants. You see this in terms of changes coming in the private markets and accredited investor regimes. But of course, all of these regulators have, when they are responsible for trillions of dollars worth of transaction, must move cautiously in the space, because one over-regulating or under-regulating can crush industries and participants or can leave folks vulnerable. So they're moving into this space very deliberately and in a sophisticated way. A number of years back, we're in a presidential election year, and in the year 2000, I had the pleasure of listening to the Libertarian candidate's acceptance speech for his nomination. And in that speech, he mentioned that personal responsibility is the price for freedom. And the gist of the comments were, in the early days of the United States, we didn't have social safety nets, and communities came together. They took responsibility for one another. You had these local safety nets as folks took on those responsibilities. As those have been displaced by federal-wide social safety nets, we've lost that sense of local communities. That needs to be regained if we want back personal responsibility. Well, the same thing applies in our industry. If we want to avoid over-regulation, we really need to police ourselves in the industry. And you've seen this with the Digital Chamber. So for example, with FATF's travel rule, FATF, the Financial Action Task Force, is looking to ensure that there is proper protection for international transactions to prevent any money laundering. The industry came together under the Digital Chamber's leadership, and we participated in the InterVASP working group. This working group produced, in really record time, the standard for exchange of financial data to meet the travel rule. That is, the requirement to know both the beneficiary and originator of every transaction by name to prevent money laundering. This is a remarkable standard that meets and exceeds the standards of the banking industry with SWIFT. So it shows how quickly we can move together as a community. Now, Securrency's mark in the blockchain space is our compliance tools. So we have a set of tools. We're working with regulators here domestically and abroad, demonstrating that for decentralized transactions, we can actually enforce the regulatory frameworks of multiple jurisdictions simultaneously. So when you engage in complex exchanges of on a decentralized exchange of instruments that have complex rule sets associated with them, we have the tools to make sure that those instruments only do what they're allowed to do. This automates compliance and has the ability to take the financial sector spends $240 billion a year on compliance. We believe we can reduce those costs by 90% through automation and this tooling that is smart tokens that know what they're able to do. All of this points to the overall strategy for our industry, which is active regulatory engagement. We need to work with, not around regulators. And what we found in our pursuit is the regulators are eager to work with innovators in the space to innovate and even advance the regulations on their own. And so that's what you're going to hear today from the panels that follow. It's my distinct pleasure to hand over the mantle to Jeff Truitt. He's Securrency's Chief Legal Officer, to introduce the next panel. It's the one that you've all been waiting for. So Jeff, take it from here.
Thank you, Dan. Our panelists are so accomplished that they truly need no introduction. We are honored to have with us today for our first panel, Jay Clayton, Chairman of the United States Securities and Exchange Commission, and Brian Brooks, Acting Comptroller of the Currency. Our moderator for the first panel is Jackson Mueller. He's the Director of Policy and Government Relations at Securrency. Jackson, over to you.
From and to Chairman Clayton and Acting Comptroller Brooks, thank you guys for agreeing to participate in this event. We really appreciate it. As it relates to what we're looking at today. So again, two sides of the American coin: a focus on innovation and regulation of digital assets, and I think it goes without saying that you guys have been quite busy over the last week between the two of you, if not the last couple of weeks and months in this space. And so I really wanted to focus on a number of areas for this discussion today. The first being talking about innovation under a mature regulatory framework. And I think, listening to a number of your presentations and comments in the past, there's a recurring theme in both of your approaches to innovations in the digital asset space, and that is that innovation can flourish while still complying with our respective regulatory frameworks. Now, Mr. Clayton, I've got about 10 pages of statements from you, since you became chairman of the SEC that really reflect that theme. And Mr. Brooks, you've been quoted quite a bit in recent weeks, and you've also been consistent in this messaging since really joining the OCC. So I guess a two-part question to this larger question, are our current frameworks sufficient to address new innovations and future developments in this space? And then are there particular areas of our current framework that are problematic for you and that could potentially require legislative efforts to address in order to spur innovation forward? So, Mr. Clayton, let me start with you, and then Mr. Brooks, you can piggyback on top.
Sure. Thank you, Jackson. And the short answer is yes. Our regulatory framework, the principles of our framework, it's time tested, and it's been time tested through many innovations. For example, if you talk about trading today, all trading is electronic. Our exchanges have gone electronic. Every trade you do, if you call your broker and say, I want this, it gets routed through an algorithm executed, et cetera, electronically. That was not the case 20 years ago. It may very well be the case that just as you had stock certificates and now you have entries, digital entries for representing stock, it may be very well the case that those all become tokenized. But you have to stay true to the principles, which is people who are distributing stock, people who are insiders of the companies for which the stock has been issued, they have responsibilities. And one of the problems that we had was we got off on the wrong foot in this innovation. There was the theory that because it was so efficient, because it could have had so much promise, we could toss aside some of those principles of responsibility and transparency. I think now, 3 years later, 4 years later, we are in a much better spot. And we're seeing the promise of blockchain technology, distributed ledger technology, bring efficiencies to that, what I say is time-tested framework. With that, let me turn it over to Brian.
Well, look, first of all, thanks, Jackson, for having us both here. I think the fact that you've got the OCC and the SEC sitting in the same room talking about this tells you a lot about the maturation of what's going on here. And I honestly couldn't be more excited about the partnership between our two agencies in terms of not only seeing these issues as enforcement issues, but trying to also show the other side of the coin. That's the title of today's talk, right? There are some things out there that have been sold in ways that I think are problematic under securities laws and other rules. And there are also some things here that would be good for America to invest in and lead in, right? And I think we have to show what we think is good and safe, and we need to lean into those things in the same way that we enforce the things that we think are problematic and have disclosure issues, and that's, I think, what we're trying to do together. I think from the OCC's perspective, I think a lot of the maturation of the crypto industry is about thinking about what this stuff is about, right? And I think that anybody who's worked in the field knows that the original concept of Bitcoin and all of these other innovations was not supposed to be to create some made-up investment asset. God knows there are plenty of things to invest in, right? Plenty of derivatives contracts and equities and other ways of accessing volatility if that's what you're looking for. You don't need to make up something on a computer code to invest in if that's what you're trying to do. We think what's going on at the OCC is something more fundamental than that, and it may be challenging to the existing bank regulations, which is why we need to clarify them. But what we think is going on is the idea that networks are fundamentally more resilient and efficient than vertically integrated sort of control towers, okay? And historically, the way that financial intermediation happened in this country was that you had these central control functions administered by banks as the underpinning of all of finance. There were basically single points of failure. And if a bank went down, really bad things happened, right? We saw that in the financial crisis. All it took was one Lehman Brothers and the end of the world, so we knew it arose. Same thing if a bank data center gets taken out in a hack. That bank may be unavailable for days, creating chaos in markets. Networks don't behave that way. And what crypto tokens are fundamentally about is they're supposed to be the assets that are powering networks. They're the things that are incentivizing people to connect to the networks, such that the functionality of the network, like the internet, becomes very stable and resilient over time. So we see this as more of an infrastructure issue than an investment asset issue in its maturity. And the reason I think that people have seen what they've seen from the regulatory agencies is that we haven't achieved maturity yet. And so in the early days, you have speculators, right? And you have people trying to take advantage of speculators. But in the mature phase, what you have is a radical new payment system that may be better than existing payment systems, which are built on antiquated technologies. And since the OCC is in part the administrator of the banks that operate on payment systems, we have a strong interest in trying to envision a medium-term future, not a tomorrow future where people are speculating on Bitcoin price movements, but a medium-term future where these blockchain networks that have been built are basically the internet of finance. That's where I think this goes. And that's kind of a mind-blowing challenge to the banking model. And so I think our responsibility as regulators on the bank side is to get out front of that and help chart a course that shows that there is a future for banks in this world, that banks play a critical role in this world, and we need to establish a framework around it so the ways they connect are safe and sound.
Thanks, guys. And going back to both Brian and Jay's comments, you had mentioned, Brian, you had mentioned, we haven't, achieved maturity yet in some of these areas in this space. And then, Jay, you mentioned, getting off on the wrong foot on some of this innovation. And I think that goes to my second question of whether and to what extent is the continued discussions, in particular among your agencies as it relates to what is and is not a security, and if you go broader than that, crypto asset taxonomy. Has the focus on those issues in particular really prevented you from addressing other potentially less controversial developments in the blockchain and digital asset space, such as, for instance, tokenized versions of traditional regulated financial instruments? And I'll just start, Jay. I'll start with you, and then Brian, if you want to go as well.
Yeah, sure. And it's a very good question, Jackson, because you read about the problems, but we've got a lot of people working on areas that aren't problematic, areas where we're bringing this technology to bear. And also, I think you can characterize a number of our recent discussions that we've had with the OCC as, okay, and where can we be clear that it's not a securities law issue? That's a lot of what Brian and I, and thanks to our great staffs, have been talking about over the past few months. And how do we in the payment area, the maturation in the payment area, how do we make it clear to people that if you're not trying to finance your network, you're not trying to give people a return on your network, it's probably not a security. But if what you're trying to do is finance the build out of your network with your token, or provide people with a return for using the network with your token, you look at the traditional test of security, it's pretty clear it's a security. And we're working to make it clear where those lines are so people can mature the payment system. I don't know, Brian, is that a fair way to describe our relationship?
I think that's exactly right. I mean, look, the collaboration we had, just start with stablecoins, which is the first thing that we've done together, I think came out of a view that, look, Jay is not the security silo and I am the lending and deposit silo. We're part of a group of regulators in the government who are charged with maintaining a strong, robust financial infrastructure for the company, right? We oversee the financial system. And there are different ways people access capital and credit in the financial system. Sometimes they choose to take a bank loan. Other times they issue a debt security. It's fundamentally a fungible thing, right? Sometimes people buy an equity. Sometimes they do something else. And I think we came together around this based on the view that the country would be a stronger economy with less friction if our payment system worked better. And one of the things that can potentially help innovate the payment system and make us more internationally competitive would be leaning into stablecoin-powered blockchains. So Jay and I spent some time talking together and said, hey, on this issue, we have a strong alliance of interests where we both want to see American leadership. We both want to see a payments network that is as strong as China's or the EU's. And one way to do that is for us to say that banks have the authority to participate in these payment networks, and for the SEC to say, hey, stablecoins that meet certain conditions outlined in the OCC's letters may well not be securities, so come to us and we'll give you clarity. That's a great way, I think, for government to do what it does best, which is to provide framework rules within which industry can innovate and flourish.
No, that's great, and thank you for that. And I think this idea of coordination, is an interesting one, especially when the industry is converging on when you think of the different types of payments and methods for transacting out there. And in particular, just wanted to quickly go over another one of my questions where when you Mr. Clayton, you had talked about in a recent Senate Banking Committee hearing, and you stated that the announcement of Libra was a focal point for regulation, focal point for regulators, of different types to recognize that digitization and the digitization of the plumbing and other aspects of our financial system, including payments transfers, is coming, and that was quote unquote. I think for the two of you, when you think about bridging traditional investment assets as payments, when you think about the launch of Libra, MasterCard launching a CBDC testing platform, PayPal offering direct sales of cryptocurrency, the OCC recently awarding a charter to I believe it's pronounced GECO Bank that deals with the Treasury bills in particular for payments, and then you think about the recent charter of Kraken, I believe that was in Wyoming, and and even with and even the interaction between digital dollars, stable coins, and other digital assets, are we at a point where industry convergence is really going to drive and necessitate greater regulatory convergence in the future? And Brian, let me start with you, and then Jay.
Okay. Well, look. I would start with this comment, which is when you give that long laundry list of things, I'm reminded of the fact that in the early days of the internet, there was this massive flourishing of internet businesses, most of which failed. And that's okay. You know what I mean? My guess is that most cryptocurrency projects are going to fail. They're not going to be relevant to a particular need, or they're going to raise fundamental legal compliance issues or something like that. I don't think it's our role as regulators to say that all of the things you just mentioned are good or all of them are bad. I think, coming back to Jay's point about principles, I think it's about sort of articulating a framework, much as the EU recently issued a framework on stablecoins just a week ago, to sort of say things that meet these parameters are legal to bring before the market, and then the market can decide what it wants. Things that are outside of this framework raise real problems of investor disclosure or fraud or whatever, and probably shouldn't come before that. But within that framework, lots of legal things are going to come to the market and fail. Just sort of like lots of companies that list on the New York Stock Exchange and were there 70 years ago have gone out of business, and again, we're okay in a dynamic economy. What I try to say when I talk to people about crypto is every one of these tokens represents a different project with a different point. Some of them were fundraising schemes, that raise the issues that the SEC has identified. Some of them are trying to build a network for the purpose of using the token to add access to the network, and they're as simple as utilities. And some of them are foundational technologies that our future banking system could be built on. So I don't want to pick winners and losers here, but what I do think we need to do as regulators is articulate what we think blockchain adds to the ecosystem, and where the risks are and where the benefits are. And where there are benefits, we should not be stupid and get in the way of American success and competitiveness. And where there are issues of scams and frauds and other things, we shouldn't be shy about saying so. And I think that's what we're trying to do today, is to say, here are some rules. Let me just give you one example, and I don't mean to go on this long, but like the first thing the OCC did on crypto was come out with a custody interpretive letter to say that, hey, in the same way that banks are authorized to custody things like digital securities, or any other exotic asset, vintage cars, for example, they can custody these things subject to their normal risk management practices. And the point there was, one of the big risks in crypto is that somebody's going to steal your code and you're going to get robbed, more or less. We can help with that. Another thing we did is we came out with a stablecoin letter authorizing banks to maintain the deposit accounts that back these stablecoin projects. And that's important because some stablecoin projects have blown up because of what amount to bank runs. People thought they bought something that was redeemable for currency, and when they went to redeem it, there was no money in the bank, and that's a problem. So I think these are kind of the OCC equivalents to things that the SEC cares about in terms of somebody's buying a piece of the blue sky. There may not actually be a business there, and that's what disclosure obligations and registration obligations are about. But I do think that once you establish these rules, for example, when we came out and said you have to comply with collateral and audit standards, when we put those rules out there, the weird thing is that the market circulation of U.S.-based stablecoins went through the roof because markets like rules. They like clarity, interestingly. And I think we can have a lot of innovation once we specify what the rules are. So I think coming together as joint regulators and specifying that is going to be a good thing ultimately for the projects that are valuable.
Jay, I'll let you answer that question, but I think I wanted to add a little bit more to it. Brian had mentioned, about the need to push forward on a framework for a lot of these issues, and frankly, for me, one of my recurring nightmares in this space is reading a 2016 Government Accountability Office report that on page 3 gave a chart of all the overlapping regulatory jurisdictions in the U.S. at the federal and then the state level as well. So when you think about that overlap, as you answer my first question, how do you who's going to drive this at the end of the day, right? Because it seems like as the industry converges on a number of these areas, you're going to need regulators to band together and have a united voice on this. So who drives?
Well, I think who drives is let me first say I I enjoyed Brian's characterization of where we are and where we're trying to go. I thought it was quite good. And who drives depends on the functionality. Okay, so we're talking about stable coins as an area for enhancing efficiencies in the payment system. Well, the people who regulate the payment system, the banking regulators, they should drive this. If you're talking about, in the preamble, there was tokenization of ETFs. Well, we should drive that, and we're willing to drive that. Our door is wide open. If you want to show how to use to tokenize the ETF product in a way that adds efficiency, we want to meet with you. We want to facilitate that. Now, of course, you got to register it and do what you would do with any other ETF. But that's who should drive. And we're, I think that's what we're trying to. What we don't like is when someone says, the function is payments, so you really ought to look past the securities law stuff. I can't do that. I wouldn't be doing my job. So, but as you focus in on the function, we're coordinating around that, and that's exactly what we were doing with our statement in reaction to the stablecoin letter, which is these guys are going to take the lead on that. Come tell us about it. Don't pretend that it's a payment system when it's actually a financing vehicle. But we'll kick the tires and we'll give you our view, and then go over and see Mr. Brooks and his colleagues.
Do you guys think, at least from an international perspective, when you talk about the coordination and agency coordination here in the U.S. and just the complex system that we have currently, is that a competitive disadvantage here? I mean, when you look at what the EU proposed last week, and I admit that I haven't read through 170 pages yet of their crypto asset report, or when you look at some of the select countries out there that are moving forward on, whether it be CBDCs and their central banks are pushing forward on that. When you look at what China is doing with their blockchain services network and the promotion of that and interconnecting this with various public ledgers out there, I guess, given all of what's happening internationally, does the fragmented system that we're in, does that put us at a competitive disadvantage at the end of the day because we just can't respond as quickly as some of these other countries can?
So I'm going to jump in on that and say every situation is different, and we're not out of the COVID woods yet. But if you look at the response of the various U.S. regulators around the COVID pandemic, the ability to coordinate, but also the ability to be expert in each of their areas came to the fore. And so, I think it's a system that's actually well tailored for the complexity and various functionalities of our financial ecosystem. And look, I think we're fairly early days in blockchain technology. I'm sure it's frustrating, but if you use the old cliche, history doesn't repeat itself, but it rhymes. Go back to the digitization of trading. You had Island, ICE, all these things, and many others that all demonstrated that there were efficiencies to be garnered. They worked through the regulatory system. In fact, many of these same issues were coming up. And now we have a modern trading environment where spreads are tighter, liquidity is greater, and the like. And the same thing is probably happening in the fixed income market. So, no, I'm not. And let me just say this. I'm not worried about you can call it fragmented, you can call it overlapping, you can call it patchwork, you can call it the multifaceted, whatever word you want to use. And I also wouldn't spend a whole lot of time worrying about it because I don't see it changing. So as a pragmatic matter, you probably would just want to make it work as best you can. I don't know, Brian.
Yeah, I mean, I would I agree with all that. So let me just extend those remarks and say, first of all, the U.S. system may be fragmented in the sense that we have more regulators dealing with finance than some other countries do, but you'd be surprised how closely coordinated we all are. there are various vehicles by which we all sit together and do make policy judgments. We have the Financial Stability Oversight Council that just met last week and discusses important issues together. We have the President's Working Group on Financial Markets that's looking at crypto, among other things. And so you'll get a coordinated response out of us, I think, better than most people appreciate. But what I would tell you is the most important strength we have in this country, which a lot of these countries that have unified regulation don't have as well as we do, is we have a strong philosophy that markets rule in this country, and our role is not to command and control the economy. Our role is to create frameworks within which markets can function. And so I've said over and over again that the most important reason I'm trying to address crypto at the OCC is not because I have a bias in favor of crypto. It's because there are 50 million people who own this stuff. And so it's important for Jay to make sure that what they're buying is real and disclosed and registered and all that stuff. It's important for me to recognize that this stuff sits inside the banking system today and we need some rules around it. But at the end of the day, the thing that is America's strength and the reason that we are the most innovative country in the world is precisely because we let markets decide, right? To my point about the New York Stock Exchange companies going bankrupt, the New York Stock Exchange does not refuse to list a company because they think the product is crummy, right? They let the market decide if the product's good or not. They just have a set of rules about disclosing what that thing is. And that's what we're trying to do, at least what I'm trying to do today, is to let markets decide what they want, and then we'll decide what's legal to maximize the ability of market actors to make their decisions.
And let me just say, I think we both will let the market decide, but we both recognize that there are efficiencies that can be added to the market. How the market, but there always are. That's the beauty of this. And I am sure, I have no doubt, one of the things that always comes to my mind is security interests. Security interests are incredibly paper intensive. Anytime there's a refinancing, the filings that have to go, around the states and whatnot, and any of the leveraged finance lawyers on the phone know this area where digitization could add a tremendous amount of efficiency, without a doubt.
Let me just add in another related question as it relates to some of these international developments we're seeing, and you talk about markets driven and the like here in the U.S. But to what extent, when you see these developments, whether they be out of China, Europe, elsewhere, as it relates to expansion of their payment structures or creation of kind of monolithic centralized systems, does that pose a threat to the promotion of our financial services abroad and the values that we hold in the U.S. and export abroad?
So maybe I can jump on that because I think you're really talking about the development of things like the China e-renminbi or the EU, ECB work around stablecoin, or the UK's statement about central bank digital currency. Here's what I think, and I'm going to come back to my market point. Countries like China have an ability that we don't have, right? Which is they have a command and control economy and a single party sort of government. And if they want to dictate that we're going to have this kind of a currency, they can do that tomorrow. And we can't do that, right, because we're a democracy and everything else. So that's never going to be our strength. Our strength is, as I've said in multiple other fora, we've already built a bunch of real-time payment systems. It just wasn't the government that did it, because that's the magic of America, right? I mean, we're the people who will deliver you 8 different flavors when the Soviet Union would deliver you 1. Right. And so the question I've got is just what can we do as regulators to create a safe and sound environment where our private sector can be unleashed, because we're better than they are when we do that. And I think the problem we've had for the last 20 years or so is we haven't given clarity to the market about which of these things we think are legal and not. And that's what we're trying to start doing now, is to say, yes, we've seen some projects that we think are legally problematic. Jay's brought some lawsuits to highlight what those look like. Now we're trying to look at the other side of the coin. Here are some things that we think are highly valuable and we're okay with, right? And so we start with the easy, low-hanging fruit of stablecoin-powered payment systems, as long as they are compliant with BSA/AML requirements, as long as they're based in the U.S. and fully collateralized with fiat currency. We're more or less good with that. And if that's the standard, we've already beat China because we've got a bunch of those networks, not just their one. That's our advantage. It's markets.
Let me go back to this. My former previous questions on kind of coordination and agency coordination, since I've got both of you in this room right now from the SEC and the OCC, and in particular, I think everyone that's listening in and myself listening in from a couple feet away, really appreciates. The two agencies recognizing, the potential for overlap of authority, and the fact that you're able to work together to work out some of the kinks within this system that we have, right, and which is not going away. So I guess the question I have for the both of you, since you've been very active over the last week in particular, giving me a lot of weekend homework reading, but even before that, is do you see more cooperation ahead between your two agencies, and how do you see U.S. regulators kind of moving forward on a more coordinated approach? Does it have to be at kind of that FSOC level in addressing some of these issues, or as you guys mentioned, it can be an agency by agency basis as well? Jay, let me start with you, and then Brian.
Sure. And I think you outlined the answer, which is in some cases it's bilateral. We've done a lot of bilateral work, and that bilateral work will feed into work at the Presidential Working Group or at the FSOC or otherwise. There's no set structure for coordination. We have a lot of structures that facilitate coordination, but as things come up, look, Chairman Tarbert over at the CFTC and we have a standing call every Monday. Some days it's a half hour, some days it's 10 minutes. But where are we going to be better if we resolve things at that level quickly? So there's a lot more coordination. You see, we certainly don't announce every time we talk to each other. That would be quite cumbersome. But there's a lot of discussion.
Yeah, I think that's absolutely right. I mean, I think that broadly over time, it would be good, in the same way that the government as a government has a policy on things like housing finance, it'll be good for the government to have a broad policy framework for this kind of stuff. But like everything, it tends to start small. You address the easy questions first because they're big and easy, and I think that's what we're talking about with these fiat-backed stablecoins. And then you get to more complicated questions like the Libra situation that you raised a few minutes ago. That's got a lot of other issues going on with it. And what do we think about that? That touches multiple of our agencies. At the end of the day, I think you'll see us address some framework questions as a government, and then you'll have single agencies and bilateral cooperation on things that don't have the same breadth of implication. But I think there are things you can expect to see coming out of us. I mean, we've already said a few things. We've said banks can custody crypto assets. We've said that banks can hold deposit accounts in support of stablecoins. Should we say something about banks' ability to plug into blockchains and actually issue stablecoins? I don't know, and I don't know what the right answer is, but I know the market's asking those questions, and we'll have to figure that out. Do we believe, for example, that banks should be node validators on a blockchain for other assets? Again, I don't know, but that's where these things lead, and some of these things are broad enough to mention that we'll coordinate on it for sure. That's what we do well.
We've talked about a lot over the last couple minutes about regulatory coordination, but I want to focus now on industry-led oversight, and primarily this question's for you, Jay, but then Brian, feel free to jump in as well. One of the things that I read about a week or two ago was authored by David Wield, the former vice chairman at NASDAQ, and he was interviewed in a recent article in Forbes where he suggested the need for the U.S. government to empower a cross-industry commission to remove bottlenecks against innovation, and particularly as it relates to listing, settlement, and custody of securities tokens. And we've previously heard from the CFTC Commissioner Brian Quintenz on the importance of self-regulatory organizations in this space. Given how encompassing the digital asset terminology is there a certain area or several areas underneath that kind of all-encompassing term that you believe kind of would either merit an SRO, or you would be okay with kind of industry looking to join together in an SRO?
Well, I'm going to go back to the point I made. What is the functionality that you're providing? If the functionality that you're providing is, exposure to a venture, well, that's a security, and we have an SRO for that. If there's something fundamentally new, not that the technology is fundamentally new, but that what you're providing is fundamentally new, then you would think about that. But the short answer is I haven't seen something that's fundamentally new in terms of functionality. Like the OCC knows more about payments and bank participation in payments than anybody else. I don't think if we change the technology that's used to facilitate payments, we don't need to add an SRO to the OCC. Yeah, it's kind of how I feel about this. I don't know, Brian.
No, look, I couldn't agree more. One of the things that I found surprising when I was actually working in crypto land was how an industry whose underlying product was designed to make things simpler and faster made the policy side of it so needlessly complicated. So there were multiple different groups getting together saying, well, we need an SRO. We might need 2 SROs at one point, somebody said, or possibly a whole new government agency or a commission. Listen, the point of crypto, like the point of all innovation in any area, is to take aspects of life we've lived our whole lives and just make them easier. So we didn't need a new commission when cell phones got invented. We had an FCC, and they adopted a rule around cell phones, and that was fine. And here we are, and we have lots of different kinds of smartphones out there. I think it's the same thing here. I don't know. I'm now just reiterating what Jay said. Keep it simple, stupid. This is the people who've been successful in DC, or the people who remember, keep it simple, stupid. Okay, if you're trying to issue, rights in a venture, like Jay says, that's equity. We all know what that is. I think security tokens are great. Jay's agency has now issued guidance about, crypto ATSs and custody, and now there's clarity about how that's supposed to work. Fantastic. Some crypto tokens are about value transmission and payments. We've issued guidance around that. I think it's not in the industry's interest to have a whole bunch of governance organizations around this. It's in the industry's interest to do what they do well, which is invent product. Okay, we will try and create clarity around legal frameworks using the tools we've got, and I think we're moving faster than the government ever has before, so that's the great news. But industry is great at building product, and that's what it should do. Government's terrible at building product, so it shouldn't, but it should set rules. That's what we're good at.
Brian, I've got a couple more questions. I know we're kind of wrapping up here for time, but Brian, let me direct this question to you, because I know it's right in your wheelhouse. You've said in a recent interview where you discussed that how the old debates and previously held distinctions between banking versus investment banking, or banking versus securities, and I quote, all fell away in light of economic demand. And, finish the quotes there. I guess when you talk about the payment space, and you've done so for the past couple of minutes now, but how are these changes occurring in the payment services technologies really driving change throughout the financial services industry? And how can regulators encourage responsible innovation and progress in this space?
Well, I would just pick up on the point that Jay's been making for a while now, which is it's really about sort of functional regulation. So the comment that I made that you quoted was based on an insight that was written in a famous article in 1982, right? It was about whether banks are special or not. And that article was talking about the idea that in the late 70s and early 80s, as debt securities and asset-backed securities were first becoming a thing, suddenly it looked like banks' role as lending institutions may not be special. It may be that there are ways of borrowing that don't involve a bank. And that created an existential crisis for what banks were, because people realized that debt securities and bank loans are basically fungible, and a company can choose to raise money by going to the bank or by issuing a debenture. And when you realize that, you start to realize that the hermetic walling off of investments on the one hand and banking on the other hand may be kind of an atavism. So having said all of that, when we look at the world of payments, what I've sort of said is historically we think of banks as providing 3 core functions: deposit taking, payments, and lending. We've seen in the last 10 years that it might be more profitable to offer some of those services on an unbundled basis. This is why, we have multiple $100 billion companies that are just payments companies. that business that they're doing was exclusively done inside of banks 15 years ago. Nobody but banks did that business. And now suddenly an enormous amount of the activity is moved outside of banks. So that's kind of a big deal. Crypto is just the newest, at least certain aspects of crypto, the newest evolution of that trend. Here's a way of offering that service, as Jay says, way more efficiently. But let's not kid ourselves. It's still a banking service. That's what the word means. It's a kind of financial intermediation that allows you to pay me for some service I provided you. And at some level, I think it's important for me as a functional regulator of banking activity to extend supervision and charter authority to that activity. And crypto is just an evolution of that same thing, I believe.
Well, let me kind of try and wrap things up here. You know, and I want to quickly touch on kind of the way forward for your agencies. And, you know, Mr. Clayton, I think it's, you know, no secret that you are likely to move on from your current role shortly. And certainly the upcoming election will likely to lead to some leadership changes among the agencies, regardless of the outcome. You know, given all that the two of you have accomplished over the past several years or several months at your respective agencies, and all the changes that have and will take place in the digital assets space in the future, you know, how would you like your agencies and successors to proceed on oversight of the digital assets space, and what mile markers are you setting now that you hope your agencies will reach or at least follow in the near future? Jay, let me start with you, and then Brian, you can jump in.
Well, for those of you who think we're handling things in a responsible way, fear not. We have a great staff. These people, day in and day out, this is what they do, and they do a great job. And then for those of you who are hoping for some radical change in approach, you're going to be sorely disappointed, I imagine. But I think one thing that happens in these jobs is that over time you become more attuned to how the regulatory framework of your agency impacts the marketplace and that dynamic, and how to use your obligation to be transparent to facilitate competition, facilitate innovation. And look, largely what Brian and I are doing today, at least I hope you agree with this, and what we expect to continue to do is be as transparent as possible as to how we look at this and how our staffs look at it, which hopefully will continue to foster innovation, but will make any transition a lot easier.
Yeah, I would echo all of that. And I would go further and just say the things we're talking about today, happily, aren't political. You know, there's things that both of our agencies do that are kind of political. I mean, if you got a new controller and if there was a Democratic administration, you might see a little bit more bank enforcement. You might see a different kind of approach to consumer protection than we believe is appropriate, whatever. But I think these kinds of things, these are infrastructure issues. These are, you know, I think both parties want the country to be competitive globally. They both want the country to continue to be an engine of economic growth. I really do believe that. And, you know, some of the ideas I'm talking about, I mean, I like to sell them and make them super glossy, but they were originally the idea of President Obama's controller, right? And some of them are not. Some of them are new with me. So I would say a lot of these things are sort of our response to permanent changes in the marketplace. Those are not going to go away after the election, regardless of who wins. And I would echo Jay's comment. I think the staffs are very, very committed to the idea of safety and soundness and growth. That's what these agencies are fundamentally about. I don't see that changing.
So let me just end it there, and let me say thank you to you both for agreeing to do this. It's been a great opportunity to provide ask you some questions about this space, and thank you and your staff in particular for dealing with my incessant amount of emails. So really appreciate what you guys have been able to do, and thank you for your time. With that, I'll turn it over to Securency's John Hensel to introduce panel 2. Thank you, everybody.
Thank you, Jackson, and special thanks to Chairman Clayton and Comptroller Brooks. This has been an unprecedented exchange at a critically important time in today's markets. Thank you both for your leadership and service, and that to your respective agencies in leading U.S. and global markets forward. Ladies and gentlemen, it's my pleasure to introduce the participants of our next panel, Responsible Innovation. Joining us today are 7 respected representatives of the financial services industry. In their leadership capacities, each is helping to advance the responsible deployment of innovative technology and solutions across capital markets. I'm confident you'll enjoy today's discussion. Without further ado, please meet Jonathan Steinberg, founder and CEO of WisdomTree, Jennifer Peavy, Managing Director of Business Innovation at the DTCC, Jay Biancamano, Head of U.S. Digital Assets at State Street, Seth Hertlein, Head of Policy and Government Relations at the Stellar Development Foundation, Daniel Gorfine, co-founder of the Digital Dollar Project, and also serves as the CEO of Gattaca Horizons. And finally, Patrick Campos, our Chief Strategy Officer at Securency. Moderating today's panel is Professor Hillary Brill. Hillary serves as the Executive Director of Technology, Law, and Policy at the Georgetown University Law Center. Hillary, over to you.
Thank you for that introduction, and thank you for the opportunity to be here today to participate in this discussion on innovation and regulation in emerging fintech technologies. At Georgetown Law's Tech Institute, we not only educate students to have a deep expertise in technology, law, and policy from our esteemed faculty, we hold convenings and promote capacity building for thought leaders, policymakers, and industry leaders, and lead research in cutting-edge issues at the intersection of technology, policy, and the law. And the fintech issues that we just heard about with such a great panel that was moderated well, they are at the heart of that intersection, and they call into question what is the right way forward in regulating a traditional industry that is becoming quickly occupied by new technologies. We just heard from that panel about the issues raised by distributed ledger technologies and other fintech innovations. And I am pleased to be joined by the next panel of innovators and business leaders who are really setting the pace for these technologies to take off and be used in novel ways. We heard this morning the concept of the magic of America and the innovators in America in this space, and we have some of them here today. I'm excited to hear their views on the state of U.S. regulation, the global market, and where the industry is headed. And of course, we'll discuss each of their technologies and how they'll fit into the broader picture. While we'll be focused today on regulation and innovation, it's also important to remember who these tools are for. Across the globe, new financial tools are changing the landscape, whether it's reimagining how we use traditional financial systems or extending credit and banking, also to populations that may not otherwise have access. And the digital tools we discussed today have incredible potential to reshape markets, currencies, and lives. With that said, I'm going to dive right into the discussion, and I want to get straight to it. So panelists, please turn on your video, please take off your mic, take off your mute. I know that you've been listening intently to the last panel on innovation and regulation, and the first panel was focused predominantly on the regulation side. They're the regulators, and you are that innovation, you are that magic of America to that coin. With that in mind, I want to ask all of you, and please keep it short so we can get to some of these other questions. What are your overall thoughts, reactions? Did you have some surprises? What was touched on? I know that's a lot to do in a short amount of time, but I'm going to start with Patrick Campos from Securency.
Yeah, thanks, Hillary. And first of all, it's great to be here with such a great group, and a fantastic discussion there. I wouldn't say that there's anything there that surprised me, because we obviously track these things very closely, and those two issues lie at the very heart of what we do at Securency, focused on compliance but trying to lead with innovation in this space as well. So I don't have any kind of an earth-shattering novel response to it, except to say that I'm actually pleased to see such intelligent people leading this charge on behalf of the American people.
Now anyone can chime in. I don't have to call them.
Yeah, this is sure, Hillary. So I I actually found it refreshing. I think, for many years now, one of my biggest challenges with some of the hype around some of the new technology and innovations is this expectation that there's this rapid implementation that follows the hype, and that's just not reality. And so I think that Jay and Brian laid that out very clearly today, that innovation, any kind of innovation takes time, but it happens, right? And so having a little bit of patience goes a long way in this space.
So,
yeah, I would just like to add, I think one of the points I liked that Jay Clayton made was he started out talking about the electronification of the markets and how everything now is electronified, algorithmic. When I started in '96, and I'm dating myself here, obviously, they embraced the innovators, right? They talked. I was at ITG at the time. They talked to us, and so when they talked about rules around electronic trading, they embraced the innovators as well as the incumbents, and created a set of rules around Reg ATS and Reg NMS that benefited everyone, and that's why we have the market today. And I thought that was a good point to start out with.
So I thought that was an excellent discussion, certainly very interesting, and Jackson did a great job moderating that. But I will say, here's one of my big takeaways, is I had a former colleague at another agency during my time at the CFTC. He was working at another innovation office, who said typically the number one concern for innovators is that when they bring an innovative idea to an agency, the most common response is either no, or there's no answer at all. And it's this gap, that there's this ambiguity in terms of whether something is permissible or is not. My biggest takeaway and my biggest source of kind of compliment or applause for what we just heard is that you hear a real effort to say, if something's not permissible, articulate what it is. And then this flip side of actually articulating what is permissible and actually stating that publicly, having the confidence to let the marketplace know what those parameters are and where the line may be, is something that can really facilitate innovation and foster innovation. So I thought that was incredibly refreshing. And certainly the amount of activity that you've seen from some of these agencies over the last few months, I think is a very positive step in the right direction.
And this is John Steinberg from Wisdom Tree. From that conversation with the Chairman Clayton and Brian Brooks, the foundational principles of financial services is, I think, digital assets 2.0, and the early days of crypto or Bitcoin trying to potentially get around foundational principles may have slowed us up, though it did inspire that merging of software and currency as a concept. But for true mainstreaming of this effort on all of us, I think it really depends on embracing those foundational principles with our regulators will not give up. Know your customer, anti-money laundering. I mean, you got to live with this, own it forever.
So I would just echo some of the things that Daniel said. I think that one of the most important things is just that this conversation is happening, and I think regulators tend to view the world through the lens of their regulatory mandate, and it sometimes leads to a situation. It's a bit of a cliche, but when you're a hammer, everything looks like a nail. And so I think that's can be sort of why when an innovator goes to a regulator and says, this is what we're doing, to Daniel's point, the response is either no or nothing at all. And so it's so refreshing to see regulators, particularly like Brian Brooks with his recent interpretive letters, being really out front of this and giving guidance and clarity to the industry. Sometimes without even being in response to a particular question, but just seeing issues arise and thinking about them and providing the clarity that innovators need to grow and thrive. It's really great to see this.
Thank you. And we'll have an opportunity to, of course, talk more about what we heard this morning, because that is integral to what we're going to be discussing, because this is your reactions, your innovation side to the panel. And with that in mind, with the two sides of American Coin, I'm going to go straight to Patrick and ask you a question. The title of the panel states that we have the regulation, and we have innovation. So you said you weren't surprised with the earlier panel. What do you see as a way forward where regulation and innovation can support and complement the growth and ensure the benefits of digital asset management, investment, and trade? Benefits as financial inclusion and efficiency, which we heard earlier, they can be had with DLT and global asset management, but there has to be compliance. I think we heard quite a bit about that this morning to ensure safety. Unfortunately, as with many new technologies, when there's a lack of regulation and understanding, there is fraud, abuse, and that can halt any new technology growth. So please help us understand what Securrency is doing. What do you see forward? Where should we go from here?
Yeah, thanks. So, I think, and there's some really interesting points that were made, obviously by Chairman Clayton, Controller Brooks, but, also here by my fellow panelists. When you think about this issue, there's a question, and sometimes it's framed in this old statement, it's easier to ask, forgiveness and permission. I think a lot of the industry sort of adheres to that, that motto. And in some respects, one could say that, sometimes the regulatory framework sort of encourages that approach or instigates that approach in some respects. But from Securrency's perspective, we've never been sort of conflicted by that, meaning that we started off focused squarely on compliance. And, I can tell you that it's not particularly sexy in the industry. That, what ends up happening is it's a longer road. It's you sort of toil in a bit of ignominy, but you end up in a place where it works, and we're still here. And I think that the converse of that is sometimes when you set off and you kind of try to sort of blow past the compliance aspects of it, you end up having to go back and rework some of that stuff, and you create more problems. And I think the regulators were actually talking about some of that. In a very real sense, and I'm, maybe in the industry, we may be viewed as, antithetical to the prevailing winds, but on some level, and Chairman Clayton talked about this, we think that his square focus on compliance has helped the industry to mature, and actually it was really refreshing to hear, Brian Brooks, really repeat that notion back. And then finally, on this, I found particularly interesting this question that Jackson raised, and I do have to note that Jackson was fantastic. And what a great question that he asked about SROs, and I love the response because it is true. I completely agree that what's not needed are sort of more pseudo-governmental entities, but actually better cooperation among industry players themselves, not in a regulatory sense, but actually in a technology sense. I will say that one of the issues that we run into is that everybody's off in their own little technology silo, and they don't want to play together because they're afraid that they might give up IP or they might lose some kind of market share. But ultimately, the market wants a framework that works for the market participants. And I think that cooperation on the technology level, before you even start talking about SROs, is probably a good starting point, particularly when it comes to compliance.
Well, at the Institute, we fully support cooperation with technologists in all aspects of policy, law, and regulation. They're first to go to understand how this all can work and integrate together. And I think your point about working together in order to promote products that promote security and compliance and interoperability in the future of this area makes sense. And your company, we heard earlier, has quite a bit of work in that area. And I'm going to move because of time. I would dig in a little deeper, but I'm going to move because of time to Jono. I'd like to talk about your company, WisdomTree. It's been pursuing the first digital fund in the U.S. market. And your innovation has been in line with regulation as you're moving forward. You're currently in an evaluation process with the SEC. Can you explain to us a bit more about the benefits of a digital fund compared to traditional funds, and dig in a bit more about what global distribution of digital assets and how innovation and regulation can streamline global trade of digital assets?
Sure. So, we thought that there was an opportunity to do something better than the ETF, which is to incorporate the blockchain technology into the ETF ecosystem, and that you would gain certain greater efficiencies, audit trails, real-time settlement, and one of the other benefits could be global liquidity. Global liquidity will depend upon our ability to stitch together global regulation. Sometimes the regulator moves slowly. Now, we've found the regulators, and our primary regulator is the SEC. They're very happy to engage, particularly if you are embracing those foundational first principles, which we do. The SEC was certainly facilitated the growth of the ETF. If you want to see digital assets go mainstream, in my opinion, they'd have to be better than the ETF, which is to date, the most investor-friendly structure created. You'll also need regulation to approve that, so you have to work with the regulator. Now, sometimes, if you go back to ETFs, it took a long time for the American Stock Exchange working with the SEC to get that approved. I think to the benefit of everybody on this call, our government does understand the national security issue of China embracing their digital currency. So the world regulators will want more global standards. I do not believe, unless we are incredibly complacent and slow-moving as a nation, and this is for the regulators, that we could lose our status as the reserve currency of the world. And it's not easy for a global standard to get established if the United States isn't a part of it. So I think the rest of the world is eagerly awaiting for us to continue to evolve and approve, the appropriate projects. For WisdomTree, mostly we're trying to tokenize traditional assets and get the benefits of the blockchain. With that, I'll pause, Hillary. I know you have lots of panelists.
Thank you. I appreciate that. And I'm going to now turn to Jay. I want to talk a bit about State Street. Many investors look to State Street as a leader in financial services industry, and they're going to want to be interested in your role now in this digital asset space. Your company publicly states that it is client-centric. It's looking where clients are interested in investing. It appears now that there is a clear trend and clear interest in digital asset trading and other digital forms of value. It sounds that it's clear here both in the US and, as we heard this in the first panel and just from our previous speaker, it's an international interest. So what aspects of digital assets and perhaps DLT are most interesting to State Street?
Well, thank you. It's we've been looking at the space for a number of years now, and what I like to tell people is we move when our clients move, right? So we're client-centric. Obviously the focus on crypto.
I'm sorry, can you speak a little bit louder? I don't know if I'm the only one who can't hear you out. Speak a little bit louder. There you go.
I like to, we're client-centric. So we're really focused in on where our clients want to go. And a lot of the conversations recently has been obviously the ETF conversation, right? That's an area for us. We want to be a leader and an innovator there. But we're also looking at assets that have a lot of drag, the illiquid assets, right? So when we talk about compliance, which assets have the most compliance issues around them? And that's really the illiquid markets, such as real estate, such as private equity, such as intellectual property, and the like. And that's where we're seeing the most innovation. We do talk to a number of clients about that space, about tokenization there, and we're kind of excited about some of the solutions, the compliance solutions we've seen. If you decrease drag, you increase interest. And if you increase interest, you increase liquidity. And that allows more of these asset managers to move into this space. So we see the opportunity early on in the illiquid assets, in the real estate assets. Now, Jono had said, traditional assets are exciting to him as well. We are looking at that as well, but we think it'll be a follow-on. We think the technology will probably be proven early in the private asset and alternative asset space, and that's where we're kind of focusing our resources. Now, for DLT as a technology, we see it as an infrastructure play. And I know Brian Brooks had mentioned that the technology is there to solve problems. And for us, there's a lot of problems around collateral. That's an area we're looking at, and certainly custody is an area that we have to focus in because we're a custody bank. So, at the end of the day, it's really, looking at new issuances in new asset opportunities, but also being able to improve processes and infrastructure using DLT technology.
Perhaps you can specifically comment a little bit about the role of regulators here, and should they go beyond their traditional role? Should they reduce their role? Or a little bit more about? I know you spoke a little bit at the beginning of the panel, but what do you feel about the regulators?
I like the fact that the regulators are embracing this technology. When they said markets like rules, they do. They also want to ensure those rules allow for innovation. I tell people when we talk about blockchain and the SEC, the early conversation around Bitcoin and ICOs kind of turned a lot of people off. But I think lately they've started to embrace the technology and understand that increased transparency is a benefit. Right? And looking at increased transparency allows them to look at the inefficiencies in their market. So if we look at the equity market right now, there's a lot of manual drag, especially in the compliance space. Rules such as OATS and CAT, they're not really efficient. Using blockchain technology, DLT technology around that could improve that, immensely. It could be real-time type of surveillance. So we really appreciate the conversations we've had with the regulators. And the one thing that really excites us is they're looking not only at the incumbents, such as State Street, but they're also talking to the innovators, right? They're talking to the new startups that have the solutions for these technologies. So I think, they're bridging the gap between the old world and the new world. And I think they're doing it in a way that they're taking the right steps, and they're doing it in a way that they're not over-regulating. They're not regulating by enforcement. They see the solutions, and I think the pace they've been going recently it has been increased, but I think that's on purpose. I think they've understood the technology a lot better, and they're willing to opine on where they think the market should be going.
Jennifer, and also please, panelists, we will have an opportunity to discuss what you've heard from other panelists if you hadn't had a question. So I'm just going to make sure that each of you gets a specific question, and I'm going to move on to you, Jennifer. The DTCC organization, it's been around for a long time. It's been around since 1973, and its goal is to reduce costs and increase efficiencies. Innovation, frankly, is at its core, even though it's not today's actual brand new technology, but innovation was at its core. The continued digital transformation of the financial services ecosystem today brings with it greater efficiencies now, right, for clearing and settlement. So can you describe for our audience some of the current initiatives where DLT is being used at the DTCC in a way to promote your traditional clearinghouse role?
Yeah, sure. So I think it's really interesting, the word innovation. I think the panel before us talked about this a little bit, but innovation is in our minds about modernizing and introducing standardization, automation, effectively just delivering client value in a way that it makes their jobs easier. Same way that our cell phones have dramatically changed our lives, right? And, so if you take those business opportunities and you combine the strengths of your organization, right? What do you do well? How are you meeting your client on, their needs and pain points, addressing their pain points? And then you take this lens of, what's in this technology innovation toolbox and how do you apply that to create the most effective and efficient end-to-end process? I think that's where you end up with like this sweet spot in the innovation space. And, I even tell within our organization, I tell people that, innovation is not just about using blockchain or digital assets, right? And there are lots of different technologies that can contribute to innovation, right? Most importantly, though, is how do we modernize? How do we get past, some of the friction, some of the manual processes that we have today? So the way that when we look at it, I kind of see, DLT and digitalized assets fitting in two areas right now. And Jay touched a little bit upon this, right? I'm going to be really specific, though, about private markets versus public markets, particularly with regards to equities, because I think, you know, being clear on that front is important so that we don't blend some of the themes. But white space right now, I think, is a great opportunity for using digitalized assets. So as Jay mentioned, private markets, alternative space, creating efficiencies in markets where they are predominantly manual in nature, they need distribution, they need proactive transaction compliance, and they need an ecosystem, right? Those types of markets are really great opportunities to be looking at digitalized assets. Unfortunately, I think the majority of some of the startups or some of the innovators in the space tend to focus on what exists today, right? Some of our traditional assets, which in the public market space, they are fairly efficient, right? They work very well. They are efficient. They may not be using the latest and greatest tools, but they are efficient. Now, that doesn't mean we don't need to modernize them. So the second space that we look at is how do we leverage some of these newer innovations to modernize what we're doing today, right? So we are not alone in facing modernization. Lots of financial institutions have these same challenges, legacy technology, coders that are effectively aging out, or coding languages that are aging out, right? And so we're seeing the impacts of that. And so how do we now take these newer innovations and further automate? And so we are looking at both of those spaces. In the white space opportunity, we've got a Project Whitney, where we are exploring how DTCC can introduce digital infrastructure to facilitate a digitalized asset ecosystem in private markets, right? And that's a very interesting and exciting opportunity for us to explore. And we've been talking to many of the panelists today about that opportunity and just the understanding, you know, is it viable and how it would meet the needs of the industry and what the value it actually brings. And the second opportunity a project that we're working on, which now talks about how do we really modernize some of our existing end-to-end lifecycle processing and asset servicing, is Project Ion, which is focused on exploring the value of DLT and digitalized assets for our public market equities and accelerating settlement to a T1 or a T0 settlement cycle. And so I think there are some interesting opportunities that we've uncovered in both of these projects, mostly in our deep engagement with the industry and extracting out their insights and understanding, you know, learning about their ability to adopt some of the newer technology, their interest in wanting to modernize in this way. I think both of those projects have really been pretty insightful for us and exciting to move forward.
Thank you, Jennifer. And I want to talk to Seth. I want to ask you a bit about the Sellers Development Foundation. We're going to pivot from talking about current existing institutes to something new. You're a relatively new organization. You define your mission as creating equitable access to the global financial system. And as we've heard, this issue is not just a U.S. issue. It has to do with the global financial market. And Stellar is a distributed ledger system. You are a new technology. You rely on blockchain technology and a decentralized system. Now, we can imagine what your answer is going to be because of your system, but what are your thoughts on the debate? This is a bit of a different issue between private permission ledgers and open public ledgers, particularly when it comes to security and compliance in this area.
Thanks, Hillary. I love that question because it gets to the core of what makes blockchain so powerful, and that is decentralization and trust. Economies run on trust. Without trust, two parties won't trade, and so there is no commerce. A holder of capital will not invest, and so there is no finance. Historically, trust deficits were solved by intermediaries. Two parties who may not trust each other could still transact if they both trust a third party. Our entire financial system is built on this. But there's a tension there. Just because you trust an intermediary more than a stranger does not mean the intermediary is, in fact, trustworthy. Our entire regulatory structure is premised on regulating the intermediary. But in decentralized networks, there is no intermediary. And if you are a centralized authority, this might seem scary to you. We saw this play out with Libra. Libra's initial vision was to be decentralized, but the backlash from public institutions was so intense that their response was increasingly decentralized. Why? Because regulators need something to regulate. And I think this is a cautionary tale for the larger blockchain industry, and one that we should not take lightly. There are real conversations happening in regulatory bodies around the world about prohibiting or severely restricting decentralized networks in various ways. That's happening at the FSB, FATF, others. And recently, some US policymakers have explicitly called for the government to be given super user status over blockchain networks to serve as the trusted third party. But this utterly misses the point. If recent history is any guide, not every trusted third party proves worthy of our trust. We see this starkly in some foreign countries, but even here in the US, public trust in institutions has fallen so much that people are often more comfortable trusting a stranger than a corporation or even a government. Through decentralized systems like Stellar, you no longer have to choose who to trust between the stranger and the salesman. Open public ledgers mean you don't have to trust anyone. And that is what makes them revolutionary. So to answer your question, I don't think there really is a debate between private permission ledgers and open public networks like Stellar. They're fundamentally different, and in my view, not in competition with one another. The more important debate, the one we have to win, is convincing society at large and intelligent public policymakers that decentralized networks like Stellar are a public good. And if we fail to do that, we may all follow the Libra example and see the creative dynamism of the blockchain industry we know today sacrificed on the altar of regulatory comfort.
Well, taking off on the theme of, I guess, regulation, a little bit different than regulatory comfort, but regulation. What are your reactions to the recent statement by the comptroller regarding the regulatory clarification for stablecoins?
I welcome it. I welcome it. In many respects, the letter was kind of the common sense result. When I read it, the first reaction was, well, yeah, that makes sense. Of course, banks can accept fiat deposits. They've been doing that for centuries. But this area is so new, I think it's really helpful for a regulator like the OCC to be out front, providing the clarity and certainty that the industry needs to mature in a helpful and non-threatening way. And so I really give kudos to Comptroller Brooks and his team for being on top of it. The one area that the OCC is obviously still grappling with is decentralization, represented in the recent stablecoin letter by the reluctance to address self-hosted wallets. And as I mentioned before, decentralization is what makes blockchain a useful innovation. And so if we can't get comfortable with decentralization and we strip that attribute from the technology, then there's really no point to blockchain at all.
Thank you. And Daniel, the digital dollar, we have gotten to you. The Digital Dollar Foundation, it advocates for the development of a U.S. digital dollar, an effort which at its core is both similar to traditional monetary systems, but dramatically different. It's hard even for me to conceptualize that we don't have the greenback or like a traditional dollar to hold in my hand. But this is embracing new technologies to completely change our traditional system. And I want to say, given the role of the dollar in international commerce, and we heard about this, and we heard about China, and I believe one of you, were talking about that. I think it was you, Dono, that was mentioning, concern about that, and the strength of our financial services system. Do we necessarily need, or do we want a central bank digital currency? What factors are driving this need?
Great. No, thank you. And actually, I think Jono did a great job in making the case for why we need a US CBDC. But before I even jump into that, though, I want to kind of pick up on something that Jay said and that Comptroller Brooks was mentioning, and that is a lot of this discussion around current innovation really is about infrastructure. It's about the plumbing of our financial markets and our financial services system. And if I were to drill down even further, I would argue a lot of this is really still about the internet and how it continues to flow through financial markets and services. What I mean by that is that the internet, as we know, connects computers. And the more you can automate the flow of information, whether it be emails or actual transactions of financial instruments and assets, the more we can automate and reduce the amount of friction or intermediaries involved in that process, the more you can drive lower costs, greater efficiency, perhaps greater resiliency. If we design it right, we may even solve for certain privacy concerns. So I think net, that's what this generation of innovation is really all about. Now, tokenization and blockchain play a really large role in that. The same way you can send an email halfway around the world to an individual with very low cost and few intermediaries, The same is true today about financial instruments and assets. You can tokenize them and send that unique ownership information halfway around the world with few intermediaries and low costs. So that's going to touch, I think, all types of financial instruments and assets, including money itself. So that kind of leads me to your question. You know, why are we talking about a central bank digital currency? Well, we've already seen that there are public sector and private sector efforts underway that really would impact the nature of money. And what they're purporting to do is to create digital bearer instruments. And so what that means is, just like you talked about the greenback, it's physical cash. That's right, it's a token. It's a physical token, and it's a it's a physical bearer instrument. What we're arguing to do is to create a digital version of that, so someone can actually hold what becomes the digital greenback. Now, to the point about being a reserve currency, you're absolutely right. I mean, the US is the global reserve currency, and there are a lot of reasons for that are unlikely to change overnight. I mean, of course, what drives it is things like good governance, rule of law, economic stability, ubiquity, and the fact that most of the world has adopted it for trade. Those things won't change overnight, but technology and friction in the way that instrument moves is a factor. And over time, whether it's an evolutionary trend, it could erode some of the role of the US dollar. But even if you don't want to view this as like, hey, let's not be pessimistic, let's look at this as an offensive opportunity. So I'm going to quickly talk about what could be done potentially and why we should be actively testing a US central bank digital currency. And I'll lay out a couple of different scenarios. Now, of course, the US payment system does work very well. So to your point, for most purposes, in most instances, it does work. But let's talk a little bit about cash. We know that cash is in decline in most economies around the world. I do think inevitably that will touch the US itself. When you start talking about the or underbanked, they rely on cash. So there is a big financial access and inclusion element here. If you do, as I was kind of indicating, create a tokenized dollar where you can kind of promote access to financial services in an online setting, that can have huge benefits. Merchants still pay large fees when they're using various payment networks. This would be competition, just like physical cash is competition to other payment models, so it would be a central bank digital currency. In wholesale, capital market, and international transactions, you could see this increasing efficiencies, as Jennifer was just talking about in settlement. You can see that this driving efficiencies in how you move money across borders. But at the end of the day, I think the key point here is that this can be a real offensive opportunity for the US to enhance the status of the US dollar, but you can't flip a switch and decide you're going to tokenize the greenback in a couple of weeks. This is going to take years, and we have to be very thoughtful and make sure we pressure test this with a cross-sectoral, multi-stakeholder type group that can really think about the consequences of actually rolling out a digital dollar across the economy. So that's what the Digital Dollar Project is focused on, and why we think it makes sense to move forward now.
Well, I want to talk about regulation related to the Digital Dollar Project and the conversation we heard this morning. I want to ask you directly: is the current framework capable of supporting what you want and your project?
Yeah, I think back to the conversation from this morning. I mean, look, in many instances, it's pretty clear what a financial instrument is and what category or definition it fits. So here we're talking about something that would have to be issued, if it's going to be a public money, if it's a central bank liability, it would be issued by the Fed. The Fed already has that authority. This is just a digital representation of them instead of printing cash. Now, certainly when you start thinking about these new models, yes, it's possible that the processes around the way you transact could change because of the technology. So maybe that requires tweaking of rules, a look at new risks that may be posed to the system. So for example, like digital asset custody becomes critically important. Safeguarding a token, especially if it is a digital bearer instrument, that becomes critically important. This wouldn't be an accounts-based system. This is now whoever holds the instrument. So certainly you'd want to look at custody as an issue and make sure that's being done to the standards that it would need to be done for it to serve the purposes of the US dollar. BSA AML, you want to build a regime around digital money that satisfies people's privacy expectations and US norms and rule of law around privacy, but also takes into account legitimate law enforcement interests. So yes, we will need to think about those rules and make sure they're applied appropriately to the technology. but the general construct of what it means to be a central bank liability wouldn't be a new one.
Another key value point on thinking about introducing, a digital dollar or digital currency is, as we're talking about innovating some of our end-to-end processing and lifecycle events around certain assets, using tokenization, digitalizing those assets goes so far, right? So if you improve the underlying infrastructure, you improve the automation around the asset itself, and then you get to settlement, and you still have your old payment rails behind it, et cetera, you're not really maximizing the value of what you could get out of that innovation, right? So I think just keeping that in mind and how something along those lines could help trigger momentum in that digital asset space as well, I think is really important.
Thank you, Jennifer, for adding that. I realize because this is a virtual panel and I believe everyone can only see one speaker at one time, I had the opportunity to see all of you at once, and I'm seeing a lot of heads shaking up and down in agreement. Fortunately, I haven't seen anyone, dramatically disagree with each other, or not fortunately. Maybe it would have made for a more exciting and kept you awake during your lunch hour. I do want to pivot to a question that is open to anyone on the panel. And it echoes what was asked earlier to the chairman and the comptroller. And the question was about our position and our global position in here in the U.S. and our competitive position at the international level as it relates to our capacity to support ongoing developments in the digital asset space. You're all industry leaders. You all are, or you're using leading industry technology. Several of you touched on this. We talked about it briefly. But finding the right balance between regulation and innovation, trying to figure out how we do this with the existing infrastructure, are we putting ourselves at a competitive disadvantage relative to our international peers and competitors?
Well,
Ed, who wants to take it?
Yeah, I think this is one of the biggest problems in this context, but it's also one of the easiest to fix. So I think the lack of regulatory clarity that we have around certain aspects of digital assets is a source of risk for U.S.-based innovators. And one of the things that we're seeing is brain drain. Many American companies are innovating in blockchain are choosing either to move to a country that provides more regulatory clarity. I think Perry Ann in her opening statements mentioned Singapore and Switzerland as a couple of examples, or they're restricting American citizens from participating for fear of the regulatory repercussions. And I think either way, the U.S. is missing out and ceding leadership of this technology to more welcoming jurisdictions. And this is entirely policy driven. Are we really protecting consumers by pushing innovation offshore? I would say no. And I think it's a false choice to view regulation and innovation as zero sum. Of course, regulation should be protective of consumers, but carefully tailored regulation can both protect consumers and provide the certainty and flexibility that innovators need to thrive. We can have both. And I think this should be the North Star for regulators. I think SEC Commissioner Peirce, through her crypto safe harbor proposal, is an excellent example of a regulator striving to strike this balance. In terms of the right framework for regulation in this area, I would encourage policymakers to look to the early days of the internet for inspiration. You've probably heard, some of the acronyms of the technology protocols underpinning the internet: HTTP, TCP/IP, SMTP. You don't need to know what those mean. What's important is that those protocols themselves are not directly regulated. Of course, the many activities that have been enabled by the internet are regulated, and rightly so. And we at SDF believe that blockchain should follow the same model. The underlying protocols that many refer to as Web 3.0 need not be regulated directly. They're basically just code, like the internet protocols. But the activities that are enabled by blockchain should, of course, follow the same rules that those activities would be subject to off-chain. We should regulate activities, not technologies.
So Hillary, I'll follow on that, and it's funny because when I speak with Seth, we are 99% in agreement on it. I think we've stumbled into the 1% here, and only on this point, because I agree with Seth's general principle, but you wanted a little bit of disagreement, so I'll indulge you, Hillary.
Thank you.
You know, we kind of see it from the another angle, I should say, not the other angle, but another angle, because obviously we operate internationally. I'm speaking to you, you know, from Dubai, where we have a large operation down the road in Abu Dhabi, run by the handsome John Hensel, who you saw earlier today. And you know, we talk to the regulators here. We not only speak with regulators, but we, you know, we are engaged in helping them to speak with each other and see how technology can, you know, sort of support and facilitate their further interaction. I can say this, that for all the talk about how the US might slip behind, and this is not to denigrate any other jurisdiction, there's some fantastic work being done all over the world. Singapore is, you know, the FCA, we're seeing great things happening in Germany with BaFin, but nonetheless, because of the vast amount of you know, financial innovation that has taken place in the United States over the many years, because of the vast size of our economy, regulators, responsible regulators, will still look at the United States and say, what are they doing? How are they doing it? It is still the, you know, what I would call the pole star for best practices, and so what we're finding is actually that this technology is allowing regulators to talk more with each other and see how they can innovate. And if you go back to, you know, some of the comments that our CEO Dan Doney was making earlier, you know, we're very squarely, we at Securency are very squarely focused on what we call, you know, financial logistics and really optimizing financial logistics. And the core of that is, you know, really using technology to defragment all these overlapping regulatory regimes. Those cross international lines, but also within the, you know, the regulatory frameworks in the United States itself, right? And so technology has a role to play there. And when we go back to the question that was batted around by Chairman Clayton and Mr. Brooks, the, you know, should the regulatory agencies sort of merge? Well, no, but technology can help them to do their job in a much more efficient way. And that's actually what we're very squarely focused on. And so we call for interoperability among, you know, industry, but also using technology to defragment overlapping, you know, regulatory and jurisdictional regimes.
Patrick, I do agree with you, and I think that, look, the U.S. does, you know, remain a real model. I will say, that being said, one of the things that I've frequently have thought about and think about still are what types of tools do regulators need, though, to be able to stay effective and keep pace? Because I do think the speed with which things are developing and then being adopted is a new challenge for regulators. I mean, you know, it used to be, if you wanted to scale a business model across the country, you had to literally procure brick and mortar buildings and hire legal teams and compliance staff before you could scale nationally. Now you see the creation of an internet platform. You can scale nationally and internationally in 6 months and be transacting billions of dollars, right? So you know, thinking about those tools, I mean, I do think clarity and certainty is very, very important. So I think we heard that this morning and talked about it. I think soft power matters. I think having, you know, national policies to a certain extent to focus attention on areas where we do see some positive innovation is really important. I think Controller Brooks kind of alluded to national policies. Certainly from a digital dollar project perspective, we do think this needs to be something that the public sector is really engaging the private sector on, leveraging the innovation and talent and the developments taking place in the private sector to make sure we support something like CBDC. The last thing I would end with here is that testing and experimentation is so important. Like, our rulemaking process takes years, right? So the problem that we have with regulation now is that we're typically 5 years down the road when we're trying to create new rules and regulations, and within 5 years, everything has changed dramatically. So creating very clear space for innovators to be able to innovate, where we can then measure outcomes, and then if rules need to be changed to either prevent certain harms or to promote good practices, that should happen, but that shouldn't happen at the expense of stunting everything until, you know, a 5-year process has run. So those are the kinds of things I do think about in order to maintain our edge.
Any other takers? Well, I know that we were supposed to originally wrap up around 1:15, but I want to ask, a final question. But before I do that, I do want to wrap up our last discussion, which I believe specifically, Seth, you touched on, and it was one of the quotes I took away from this morning about active regulatory engagement. It seems to be that is something that is happening. That is something that the chairman and even the comptroller were participating in. Are you are you supportive of active regulatory engagement? Number one. Number two, if you could, in order to, and use another quote, unleash the power of the American workforce and private sector and our energies and creativities, and could create a dream regulation or eliminate something that is a hurdle in your way, what is it? And who wants to be the first taker? Go ahead, Jono.
Engaged with regulators, both in the U.S. and abroad, and we're trying to get traditional assets in token form approved by U.S. regulators. I mean, that's really doing exactly what, they're engaged with us, and we're trying to unleash what will come from those new digital assets. And for me, luckily, we are a partner, or we led the Series A investment in Securrency. We didn't think we could actually access the blockchain and with regulated tokens without their help. And I thank our partners at State Street, who underpins much of what WisdomTree does. So we're bringing, a real case to the government to hopefully at some day approve, which will then have trickle effects on other services and functionality. So we're trying to do it. I guess I'll pause there.
So Hillary, I guess I'll just opine. I think obviously having conversations with the regulators is immensely helpful, right? We engage with, FINRA, SEC, CFTC in different capacities all the time. And I think some of the newer initiatives, and Dan led the CFTC lab, and, we have SEC FinHub, and I sit on FINRA's FinTech industry committee. And I think all of these things are additive. They're very helpful. I know they're meeting with lots of different types of firms, incumbents as well as new startups. So I think those conversations are really helpful. And I think understanding what you're doing, I mean, regulators do regulate activities, right? They're not regulating technology. And so understanding how the use of technology is changing how something can be proven out, right? I think we run into this in the private market space, in terms of thinking about something like good control location, right? And being able to custody assets on behalf of customers, broker-dealers being able to custody assets on behalf of customers. So I think, understanding how the use of a different technology actually changes your ability to meet that regulation, those are the things that I feel like are the most valuable outputs of those conversations, because then once you know that, then you can go back and figure out how you solve for it. So I think that's kind of our take on it.
Yeah, I would just like to add, what we, from a higher level, jurisdictional alignment is a challenge. Like Jennifer just said, we have a number of conversations going on with a number of entities internally. In the U.S., you have CFTC, you have SEC, we have the Fed, you have OCC. We also have international jurisdictional alignment that needs to be pushed. And I think that's really where the biggest challenge is going to be, is getting international regulators to work together to understand this technology and ensure that this technology is instituted in a way that allows innovation, but also, I wouldn't say protect, but also allow us to maintain the U.S. capital markets, which are the leading capital markets in the world. Because at its heart, blockchain is a democratization tool, right? It allows different entities to compete on a level which they haven't done before. We talk about how the rest of the world will be able to build wealth, the unbanked, right? And that's really where I see the biggest threat is, we have to have jurisdictional alignment, but also allow the innovation to compete with the rest of the world. And, as Jono had said, one of the reasons the attractiveness of an ETF in token form is it allows it to be traded globally. right? So right now, assets, as much as you might be able to trade them in another country, they really aren't traded globally. This technology allows them to trade globally, and I think that's really one of the most exciting areas and also one of the biggest threats.
Well, thank you. I could continue this conversation quite a long time. I really enjoyed hearing from this panel of innovators in this area. And as expected, the discussion highlighted this pull of innovation with regulation, raised questions of how to regulate, where we are in the US, and how that helps us with our helps or hurt us with our global position. And I'm glad that, Jay, you ended it with talking about the unbanked, because there are many potential benefits of this type of technology that can be embraced, and I'm sure you want them to be embraced. Thank you, panel participants. I feel fortunate that I was able to participate in this discussion. I'm now going to turn this over to John Hensel and Perry-Ann Boring for the closing remarks on what has been quite an interesting day. Thank you.
Well, thank you, Hillary, and a special thanks to our panelists, Jennifer, Jay, Seth, Daniel, Patrick, Jono, and special guest, Jono's dog, Dusty. Thank you very much for being with us today. Perry-Ann, I'm sure you'd agree with me. It goes without saying the technologies supporting today's financial services industry are evolving rapidly, and new technologies capable of removing friction from the system are being introduced on a daily basis. As our panelists just conveyed, innovation and regulation are not diametrically opposed. Efficient, transparent tools that encourage interoperability across what traditionally have been siloed markets and jurisdictions have the potential to not only reduce or remove the drag Jay referred to from the marketplace, but also improve and enhance the delivery of regulatory controls that simultaneously protect investor interests and the world's economies. Like Securrency, many leading financial institutions, including today's panelists, are deliberately exploring ways to deploy digital infrastructure that addresses identity, compliance, and interoperability in a responsible way, and frankly, in a way that, as Jennifer and Daniel said, meet and comply with today's laws and regulatory frameworks. If you'd like to learn more about Securrency and our approach to these important areas, please follow us on LinkedIn and contact us through our website at securrency.com. We welcome the opportunity to collaborate and explore areas to jointly move the industry forward while aligning with and embracing the varied regulatory frameworks from around the world. Perry-Ann, on behalf of Securrency team, thank you for the opportunity to jointly support this important exchange. The work you and the Chamber have engaged in is critically important in moving U.S. and global markets forward. We look forward to supporting the Chamber and your leadership in the future. Thank you.
Thank you so much, John. Well, we are very grateful to have a partnership with Securrency. Thank you for your membership with the Chamber. Thank you for co-hosting this wonderful event with us. It's a really just important for our community to be able to have an open dialogue with the policy community on forums like this and others. I wanted to point everyone to two resources on how we can continue this conversation and continue the work going forward. The first is an initiative at the Chamber called the Token Alliance. This is a working group that we launched a number of years ago. There's over 500 people that are participating in the Token Alliance today. We originally put this group together to foster best practices and frameworks for the responsible growth of tokenized networks and applications. That group has issued a number of best practices around the issuance of tokens, around regulatory considerations of tokens, around how to navigate some of the regulatory topics that we talked about today for tokenized networks. And that group is also working very closely with policymakers to gain regulatory clarity for this space. So for companies, for people, for groups that would like to participate in that advocacy work, joining the Chamber of Digital Commerce, and if you're already a member of the Chamber, participating in the Token Alliance is a really great place where you can work with all of our members on advancing these incredibly important policy issues. And then that's resource number one. Resource number two is Parallel. So with the pandemic, we have launched a virtual event series called Parallel Summit, and this is part of that. Our next Parallel event is scheduled for October 9th. It will be at 1:00 p.m. Eastern, and the parallel we are diving into next week is called The Tortoise and the Hare, and we're going to talk about some of these issues, and we're also going to talk about some of the applications of blockchain beyond financial services. So with that, again, huge thanks, Securrency. Thank you, John. Thanks to all of our speakers. Thank you to the Chairman Clayton, Acting Comptroller Brooks. We really appreciate you guys taking the time. Until next time, you can check us out on digitalchamber.org. And if you want to watch Parallel Summit, you can sign up at